Does real estate really build wealth faster than stocks? I'm diving into a debate that could change your financial future. Can real estate really build wealth faster than stocks? Let's find out. When it comes to building wealth, two investment vehicles often come to mind: real estate and stocks. And for many, the idea that real estate is the faster way to wealth is an unquestioned truth. But is it really? Many of us have heard the boasts of real estate moguls, touting their ability to generate massive wealth through property investments. Meanwhile, stock market investors often seem to be just getting by. But are these generalizations really fair? Are we comparing apples to apples when we pit real estate against stocks? One common misconception is that real estate is a more tangible, stable investment. You can touch and see a property after all, but does that mean it's inherently safer? On the flip side, some view stocks as risky, only for the pros. But what about the countless successful individual investors who've made fortunes in the stock market? Another debate centers around leverage. Real estate investors often take on massive mortgages to finance their deals. Does this really give them an edge, or does it simply increase their risk? Let's dive deeper into the key factors that influence wealth building in both real estate and stocks. Market trends, for instance, play a huge role. A hot real estate market can indeed generate massive returns, but what about when the bubble bursts? Similarly, a booming stock market can create wealth quickly, but again, what happens when it corrects? Liquidity is another crucial factor. Real estate is often illiquid, meaning it takes time to sell a property and access your cash. Stocks, on the other hand, can be liquidated in seconds. But does this liquidity come at the cost of volatility? Return on investment is perhaps the most critical factor. Real estate can provide rental income and potential long-term appreciation, but what about the costs of maintenance, property management, and taxes? Stocks, meanwhile, offer dividends and the potential for long-term growth, but they can also be impacted by market fluctuations. Here's a scenario to illustrate the strengths and weaknesses of each investment type. Let's say you invest $100,000 in a rental property, earning 8% annual returns through a combination of rental income and appreciation. Sounds great, right? But what if you had invested that same $100,000 in the S&P 500, earning an average annual return of 10%? Over 10 years, the difference in returns would be staggering. Alternatively, consider a scenario where you invest in a real estate investment trust, or REIT, which allows you to tap into the real estate market without directly managing properties. This could provide a more passive approach, but you'd still be subject to the whims of the market. In reality, both real estate and stocks have their unique advantages and disadvantages. The best investment for you depends on your individual goals, risk tolerance, and circumstances. So, what's your take on this debate? Have you invested in real estate or stocks? Share your experiences in the comments below. And if you're interested in more content around investing and building wealth, be sure to check out my other videos.